Welcome back to the channel. Today, we're diving into a popular strategy used by traders to catch short-term moves in the market, the 20 EMA strategy. Whether you're trading stocks, futures, or Forex, understanding the 20 EMA can help you make better informed decisions. Let's break it down step by step. The exponential moving average, or EMA, is a type of moving average that gives more weight to recent price action compared to the simple moving average, or SMA. This makes it faster to react to price changes. Today we're focusing on the 20 EMA, one of the most widely used indicators for short-term trading. One of the most common strategies is using the 20 EMA in combination with the 50 EMA. Here's how it works. Bullish signal. When the 20 EMA crosses above the 50 EMA, it's a signal that momentum is shifting upward. Traders may see this as an opportunity to enter a long position. Bearish signal. Conversely, when the 20 EMA crosses below the 50 EMA, it's often seen as a signal that the market may move down. Crossovers can be powerful, but they work best when confirmed with other indicators, which we'll get into next. Another effective way to use the 20 EMA is by pairing it with the Relative Strength Index, or RSI, a momentum indicator that measures the speed and change of price movements. Bullish setup. When the 20 EMA crosses above the 50 EMA, while the RSI is below 30, it signals a potential buying opportunity. This indicates that the stock is oversold but is gaining upward momentum. Bearish setup. If the 20 EMA crosses below the 50 EMA and the RSI is above 70, it signals a potential sell. This means the stock is overbought and may face downward pressure. Using the RSI together with the 20 EMA helps traders avoid false signals and confirms the strength of a trend. Now let's take a quick look at how the 20 EMA is calculated. It's easier with trading software these days, but understanding the formula helps. First, calculate the multiplier. For a 20-period EMA, it's 2 divided by 21, which equals 0.0952. Next, calculate the current EMA using the formula EMA equals the closing price times the multiplier, plus the EMA from the previous day times 1 minus the multiplier. This calculation method ensures that recent prices have a stronger impact on the moving average. So, why the 20 EMA? Unlike the simple moving average, the EMA is more sensitive to recent price changes. This means you'll get faster signals to act on, which is especially useful in fast-moving markets. But remember, while the 20 EMA is useful, it's rarely the only indicator traders rely on. Combining it with other tools like trend lines, momentum indicators, and candlestick patterns provides a more comprehensive picture. Let's look at a quick example. Imagine we're looking at a stock that's been trending down. The 20 EMA crosses above the 50 EMA, and the RSI is showing an oversold condition. This gives us a bullish signal. After entering the trade, we watch for further confirmation from price action to manage the position. With solid risk management, the 20 EMA strategy can be an effective tool in your trading toolkit. That's a wrap for today's video. If you found this helpful, make sure to hit the like button and subscribe for more trading strategies. And as always, let me know in the comments below which strategies you'd like us to cover next. Until next time, happy trading! Thanks for watching.